All right. Hello, everybody. Welcome to Real Talk with Matt. And we got an exciting episode today. I have a dear good friend of mine, Angelo Albano with Spring EQ. And we're going to be talking about something very interesting. And I think that we both think is very, very vital and important in this time in our industry. And we're going to be talking about HELOCs and second mortgages. And as I talked a lot, throughout the years with interest rates and the volatility of the market, and we're kind of at the peak now, and I feel like we're sliding down. Angelo's got some really exciting things to share with us and to everybody out there on how you could utilize the equity in your home for a lot of different things, things that you might not even think of. And we have a special topic to talk about here, which I didn't know of until about a couple hours ago. For those people that are looking to maybe purchase a home that the previous owner has a very low interest rate on. So, some exciting things for realtors out there and potential buyers. But I want to kick it off and just have Angelo talk a little bit about himself, how long he's been in the industry for. And we're going to go through, keep it short. I like to keep these, usually around 20 minutes or less. And we're going to talk a little bit about what are second mortgages and what are HELOCs. So make sure you stay tuned because we're going to be talking about the important one at the end. So, Angelo, I'll give it to you.
Awesome. Thanks, Matt. Very excited to join this with you and really talk about, again, what you said, right? What we're seeing in the market, a little bit of a shift, and what I call the new meaning of the refi boom, right? I've been in the industry about 20 years, been doing quite a bit of home equity lines, home equity loans over the last 12 months, roughly with Spring EQ. And man, I tell you, it has just been amazing to see the amount of volume and a day-to-day application just continue to tick up in this space, right? And we're seeing a lot of the HELOCs and the HELOans, right? So what does that mean, right? What is the HELOC? What the heck's a HELOan?
Yeah, a lot of
You know,
people, when I use that acronym, Angelo, a lot of them
right.
like, what the heck is a HELOC or
Like
a
the what? The
HELOan?
he what? So they both start out with the he, right? The HELOC is exactly that. It's a home equity line of credit. Versus a he loan, which really it's a home equity loan. So the LOAN really means nothing at the end of the day other than it's a home equity loan versus a line of credit. Um, if you have the someone who is looking to, or if you're looking to take out a line of credit, say, hey, I want a $300,000 line of credit. I want to be able to borrow, say, $300,000, pay that down, and continue to borrow against that line of credit for a certain amount of time. In most cases, it's a 3-year draw period where you can draw money out, pay that down, and then continue to draw against your line of credit. We have different options in this space where you could have a principal and interest payment, or you could have a full or an interest only payment versus the principal and interest payment. So there's a couple options out there in the home equity line of credit space. A home equity loan is really what we call a standalone second. It's just, hey, I want $200,000, $300,000. Here's your loan. Once it's paid off, it's a closed end loan, right? You pay it off and you're done with it. There's no line of
So that's
credit.
usually what, like a fixed rate?
Yeah, it would be a fixed rate product versus, potentially a variable rate on the home equity line where you could do prime rate plus that margin, which is determined upon different factors for each particular person.
Yeah, cool. And Angela, you came from basically my side of the world, the wholesale broker side. So
Yes.
you've kind of seen over the last 20 years lots of different things, I would assume, especially with rates, crashes, recessions,
Yeah.
inflation,
I've been
fake
through many.
inflation, and,
Yeah.
and here we are now.
Here we
So,
are.
like, for me personally, I've done, I don't know, I would say probably 20, not as much in this space as I want to do.
Hmm.
And I think a lot of it has to do with, it's kind of like the education piece out there, and for myself included. Like I'm versed, I know what it is and how to do it. And I have clients reaching out to me about it, but it's not something I've kind of been proactive approaching people. And I'm guilty as charged. I admit when I don't do things, and maybe I should, and it's an opportunity. But what have you seen over the last 12 months? Maybe from when you started, when you branched out of the wholesale brokerage world to the HELOC world with Spring and Q. What have you seen over the last, let's just say from when you first started to maybe 6 months ago and to now?
Well, we've seen as we continue to see, equity position remain high, right? Everybody's that has, I mean, we have a ton of equity in our homes, right? And so where we've seen, and this is what I understand the question, where cash out refinances, where you're taking the money out of your, basically you're refinancing the whole first lien into a new loan to get that equity out. We've seen a shift in that over the last, say, 12 to 18 months, where people are realizing the equity position is there, right? The equity position's there. Rates on these second liens are down as low as, five, high fives to say 8, 9%, depending upon type of property. We're talking about a primary residence versus a non-owner occupied property. So there's different flavors of what type of property we're looking at taking equity from. But either way, the equity position is at an all-time high. And then consumer debt,
Is that an
coincidentally,
all-time high?
is at an all-time high. So you have two things kind of coming together to make this perfect storm, if you will, or a perfect opportunity, is what I like to call it, in this space where, consumers want to access their funds for the equity that they have in their property. And your
I
next
read
question,
something, or maybe I watch it. I don't know. I watch a lot and read a lot, but I believe it was, I think the average, like 60% or more of households have either paid off their mortgage or owe less than half,
the numbers are about 60%. Yeah, you're right. You're right.
60%.
You're spot on. And with that, a lot of people don't realize that. Oh, well, my house is paid off. Does that mean that I have the ability to tap into that equity still? The answer is yes.
Yeah.
We can take a free and clear property with a zero mortgage balance on the first, and we can now become the first lien holder of that property and take up to, in a lot of cases with us, a $500,000 out
Wow.
against the property, right? And get into a 6% rate, say, and so those are the rates right now, the sixes and sevens, and in some cases high fives, where you can take money out on a home equity line of credit at that low of a cost.
So the rate's a lot better, the more, I guess, the more equity you have in your house. There's a term that we use, CLTV, combined loan to value, right? So
Yeah.
somebody has paid off their house, obviously that's going to be very low versus somebody with a mortgage. Maybe they got it 5, 6 years ago, and then their combined loan to value is very high. So what are you seeing with the rates? Obviously, we don't, every scenario is different, but
Yeah.
are you seeing that they're pretty well balanced, even, at the higher combined loan to values with great credit?
Absolutely. I mean, great credit, even up to your 90%, which is pretty much the max CLTVs that are
Yeah.
available out there, right? So 90% of your home's value can be taken out with, potentially including that first mortgage, right? And so, yeah, I mean, with the higher, we call the FICO buckets, higher credit scores, um, you're going to see where we can still keep those rates in the sevens, versus say a 60 to, I don't know, 65% combined loan to value or less with a decent FICO, you're still going to be in the low sixes in most cases. So as you can see, when you take somebody that is at a say 2.5% first, which they've been there for years, they don't want to touch that, right?
I
They don't
get
want to.
I get that a lot when it
Yeah,
comes time to,
no, we leave that alone. We're not going to
yeah.
refi at 8% or 7%. Now we're borrowing. Yeah, we're going to take that two, three, $400,000 in equity that we wanted, but now we're borrowing at a much higher rate versus I'm going to leave my 2.5%, or in some cases even a two. They have a 15-year mortgage, even in some cases, right? We saw 199s, heck, 3, 4 years ago,
Yep.
right? So
I'm
we
one
want
of
to
them.
leave those alone, right? We don't want to touch those. So how do we get our money? Can't go into the bank and say, "Hey, I want a $300,000, loan right now." Yeah, the banks do lines of credit, um, but you can't borrow at such a low rate, just to take a loan out. They're not going to do a unsecured loan. So what do? We go get we go get a secured loan that's tied to our mortgage, second position, say, and we're borrowing $300,000 now at 5, 6%. So you're blending your rate. You're taking a
It's
first and a
always
second now.
cheaper, it seems, with the second or the HELOan, HELOC. It's always,
Yeah.
no matter how you spin it, the payment always seems cheaper.
Well, and we're paying off. I mean, heck, I'll give you an example. I'm paying off, or I'm paying off credit card debt for some people in the
I was just
amount of
about
a
to bring that
hundred,
up, yeah.
yeah, 100, $200,000 in credit card debt at 20%, 23% interest rates.
30, usually it's I think now
even up to
some of these
higher.
cards are 31%, which is freaking asinine. I mean, it's
I mean,
crazy
yeah, we're saving people $2,000 a
a
month
month.
in credit
Yeah.
card payments.
So let's talk about that a little bit. I think that's an
Sure.
important part because a lot of clients I talk to that are interested in the loan HELOC process or a second mortgage or a refi cash out, the biggest thing is number one, as you said, debt. American debt is probably at an all-time high, and I think a lot of people, I don't want to say were not thinking, they weren't critically thinking, aka
Right.
being dumb.
In the trillions.
When when rates were low during COVID and
Yeah.
things were shut down, is that people I think overspent. And when you overspend and then prices go up, you never catch back up. And I talked to a client not too long ago. It was probably about $50 to $60,000 in debt, and there was no out for them. But this was a great opportunity because I said, well, listen, even at 7.5% for this, I mean, 7.4, that's 75% less in interest spread over 30 years, keep in mind, or 20 years, whatever you want to do. I know the
Mhm.
pricing is better with lower term, but just that alone, as you nailed it on the head, was saving them thousands of dollars a month. And then their credit score starts shooting up because they're not behind on their debt. And I think for people out there that are thinking like, should I sell my house? Should I buy another house? Should I pay off? Like, there's all these things that I go through. I'm like Dr. Phil of
Yeah.
mortgages here. I listen to everyone, talk to everyone, and the biggest thing is like what works best. And I feel like this is probably the most reasonable thing to do for somebody that is maybe in debt. But the hard part is, and this is just being frank, because it's real talk. People that have a lot of debt that are seeking for these, a lot of things I bumped into is the credit scores. Um, and we could talk about this for a minute, but like naturally, people, the first thing that they do is think, let me go to my bank. Okay. Guys, on paper, unless you're like the perfect person in the world with like 800 credit, low debt to income, perfect W 2 jobs, the banks don't want to touch your stuff. They don't. They want perfect credit, great things. Where Angelo and his company, I put some tough ones in there, and we got them through the door. And they have a really good team, and they close very fast, which is amazing. But so, like for you guys, let's just talk a little bit about maybe some of the minimum requirements.
Yeah. So, as far as credit scores, we do go down to a 640, which is very unique. And even some of the other lenders out there, or even banks, credit unions, are a 680. We have the ability to do what's more of a manual underwrite. So we can actually look at a borrower's profile, look at the income, and take that debt to income ratio, right? What's their debt look like monthly versus what they're bringing in monthly, right? So we calculate that debt to income ratio. We go up to 50. So we're allowing 50% of your, monthly debt to account for half of your income, which is definitely higher than banks and credit unions are doing today. And banks and credit unions can take upwards of 2 months to close these loans, where we're 2 to 3 days in some
You know
cases.
what's crazy? I remember, and I'll tell a quick story. So
Yeah.
before we bought our cabin up in Blue Ridge,
Hmm.
I was like, man, I bought it the right time. The house went up almost double in value. And I was like, all right, well, if we want to buy a second home, this is a perfect avenue for me to go through. First, I called Navy Federal. I was like, all right, my dad's a veteran. I have access to them. Their car rates are great. Let me just give them a call. I gave them a call. They said 120 days. I said, for what? A HELOC is like,
Doesn't
or a
surprise me.
HELOC, they're simple loans to do, right? It's
Right.
it's pretty common sense. It's
Yeah.
either it works or it doesn't work. But I was like, man, that's a long time. So at the end of the day is, just be cautious. Like working with somebody like me, you have me, and then I have Angelo. So we have middleman, lender. And our goal is to always get you through the door and be creative. And I always talk to people about creative financing. And sometimes, maybe just straight up cash doesn't work. Maybe we use it to pay off your debt and then you start saving up cash. There's so many different ways we could tackle this. So it is a great option because that allowed us to put 100 grand down on our cabin, which, we love that place. We'll probably never get rid of it. And I tell a lot of people, I go, there's a lot of things. So like, writing down the most popular things, I think with a second mortgage or a HELOC, number one, debt consolidation, freeing up your cash flow. I think that's a big thing, especially right now. Number two, I see is renovations and
Hmm.
remodels.
Hmm.
We just remodeled
Huge.
our house. I mean, I used my own cash for it, but I think that's a big thing. I think people right now, at least people that own homes, I think they're kind of in the mentality of it's not a great time to sell just because of the market. Maybe it's a great time to remodel and refresh.
Yeah.
And then when the time's right, then you have that extra money that you put into your house to get top dollar for it. So I think renovations and remodels, number two. Number three, I think emergency funds. We got kids going to college. I think that's a
Yep.
big one.
Huge.
I think shit hits the fan money is a good one because you have what, 3 to 5 years to access this money, depending what you pick, usually 3 years.
3-year draws. Yep.
Okay. And then the last one I think is investments. So people trying to buy investment properties, build up a portfolio, or buying another home like we did. So, or those are, I think, are the top four. But in lieu of time, I told you this was going to fly. Let's tell everyone about the secret sauce because I'll lead into it. For the last few years, I've seen on the NMLS and people, not people, realtors putting on there something called assumable mortgage.
But yeah.
Okay.
But yeah.
My Me naturally, I kind of focus on, and just being upfront there, I always am, is what makes me money. That doesn't make me money because you have to go through the current servicer to
Yeah.
get that low rate. It could take some time. But then also, a lot of people that are doing this, that are in these low rates, bought their houses at a lot lower price and they're selling it much higher. So today, Angelo and I just had a quick phone call about this. And I said, holy mackerel. I was like, you just opened my eyes because
Something that, yeah, you,
I was looking the wrong way for so
right.
long and I was like, "Holy crap, this is huge."
Light bulb
So,
went off. We're like, hey,
yeah.
hold on.
So if you stayed along with us this far, why don't you tell us about what you guys do and what you've had some success with the assumable mortgages?
Yeah, I mean, great. It's a great point. Matt, we're seeing so many, and I see it. I'm like, wow, this is really getting big. Where I'm getting calls all the time, like, hey, my realtor called me. They got this VA assumption. The veteran is going to take over this loan. They're going to assume the mortgage. They're going to take it over. There's different benefits to that side, but well, for sake of time, we won't get into the benefits of why an assumable mortgage. But there's that gap, like you said, there's that gap between what the home is worth, what the purchase price is going to be, or that assumable price is going to be negotiated upon. How do we bridge that gap for the we'll call them the borrower or the
But sometimes
client?
it's a couple $100,000 and
Right.
most people don't have
They
that
don't have
in
that
their
sitting
piggy
around.
bank.
So we do what's called a piggyback loan on an assumable mortgage. And not everybody does it, which is really cool, where we can say, hey, you're going to do your first for 600,000. We're going to give you the $200,000 that you need to close this loan and assume this mortgage. And we'll do a piggyback second. We call it piggyback because it kind of sits on top of that first mortgage, and kind of bridges that gap of funds to close. So now we're doing a home equity loan or a home equity line. So it's really unique in that, hey, Matt, here's your $200,000 you need for this assumable mortgage. Oh, by the way, you pay that down a little bit, you still have access to those funds because it's a line of credit. So it's kind of a win-win, and so it's a very unique situation or a product that's available to many of you out there that didn't realize this existed.
It's
So
huge.
we're seeing it every day. I'm surprised at how often I see it.
So let me ask you a question. So if I have a client that's like, "Hey, Matt, this person has a 2.3% rate, whatever, and I need $150,000," would they start the process with the seller and the servicer, and then we would somehow commingle and time
Yes.
it out so we would close simultaneously?
Yeah, you would from a purchaser perspective, or whoever the assumer or the consumer is, that's taking over this loan, yes, they would do everything the same on their end. And then you and I would be working behind the scenes to get that down payment or that piggyback closed simultaneously. So yeah, yeah, absolutely. Quick and
So
easy.
that's huge. That's huge. And there's a
Enormous.
lot of people out there with I mean, my mortgage is at, I mean, it's a jumbo loan, so it won't work.
Hmm.
Low twos. And I know a lot of people that are at the low twos. So I think this is a huge opportunity out there. So realtor friends, and you know who you are because you follow my stuff. If you have a listing or you have a client that's looking to buy a house, let's investigate this. Me and Angelo could work together with our expertise and put it together. And listen, you could get a low freaking rate on your mortgage. It might take some time to close, but the sellers obviously are down because they're listing it and advertising it. So I don't think time is really going to be an issue, but it is another option for you out there. For sure. You know, one of the things too is when it comes to these, so they're pretty easy. Like I remember the last one we did, and you know, we had some issues with the appraisal because it was in a very unique neighborhood, which I golfed there when I was up there for the summer, and it was a freaking Angelo. When I tell you, it is probably one of the most beautiful
Yeah,
communities I've ever been to.
that's amazing.
And I wonder, and now I know why people don't sell there.
Yeah,
Some of these houses are just
just sitting on them.
ginormous,
Oh yeah,
sick.
yeah.
And you're teeing off and you're looking at the Toccoa River, you got mountains behind you. I was like, wow. I talked to my buddy Brian and I was like, so where do I hit the ball? Because you can't see anything because there's like all these hills and turns.
I
And he's
can
like,
only live through you on this because I saw some pictures and I was like,
yeah.
wow,
And he's like, just smack it over there. We'll land somewhere
it'll
where it
land
should be.
somewhere
And I was like,
close, right?
okay.
And it worked.
And it worked. So, you know, it's pretty cool because the one thing is some of these, you know, banks out there, sometimes they don't like rules, sometimes they don't like different things. But Spring, I could tell you, they're open for everything, which is good. So why would somebody, and I'm just asking because it probably gets asked, like, why would somebody want a fixed versus a variable, especially if you look at now? So we got some news out there with the feds potentially. Now, guys, mortgage, my stuff. Do not change with the Fed rates. Had nothing to do with it. It's good noise. Stop listening to the bullshit out there. You know, we've seen Fed rates go down and mortgage rates go up. But in Angelo's world, it's kind of different. It's a little different.
It's interesting. You know, we have to throw a number out there. I will say this year in 2025, contrary to exactly what you're seeing out there in the market, is rates don't move in this world every day. They don't move with the 10-year treasury. They're very short-term bond related. We've probably changed rates maybe two handfuls of times this year.
And for the
So
better when you
for
do.
the better, we have
Actually, I
gone.
think your rates are less than prime with the
They
Fed rate,
are. We're prime minus. I think we're up to 1.5 right now,
which is crazy. All right, so
which is crazy.
nobody knows what that means. I'm telling you right now. So the Fed rate, which is what,
Seven
seven
and a
and a
half.
half, 7.5.
Seven and a
Okay.
half.
Banks typically, when they give you a HELOC or a line of credit, it's based off that rate plus an adjustment based off your combined loan to value, your credit score,
Yeah.
whatever.
Which is the margin.
Right. So when I got mine, it did go through a bank, but that's because this world wasn't really out there yet. I started at 3.5, and now we're at 7.75. Okay. So because the Fed rates kept going up. Now when the Fed rates come down, my payment comes down. So same with you guys, right? If you do the variable 3-year draw or 5, whatever it is,
Yep. Variable
yours.
rate.
So somebody's at 6.5 today. Feds drop a half. Do they get a lower rate, or are they still at the 6.5?
So on a variable rate, it's going to be a prime plus or minus. So it's going to based off that 7.5. So if you're at a 7.5, say margin was a half, now you're at 8%. That prime drops to 7. Now you're down to 7.5 with the margin included. So you basically are going to move with that prime rate up. Prime goes up, rates go up. Prime goes down, rates goes down. Now to your kind of point or question, if you're in a fixed rate HELOC, say you signed at 7.5%, and prime goes up to 8, you're staying at 7.5 for the life of that loan. So it's a risk reward or a risk exposure, right? However you want to look at it, right? It's like because I get a lot of clients that say, hey, we want to take the variable rate because we feel like rates are coming down, right? Or they're gonna come
That's what
down.
I would do.
I say, hey, that's a great, I couldn't agree with you more,
I think there's
but
more downswing right now today.
I think there's definitely the optimism to say rates are coming down. How does that impact mortgage rates? Again, to your point earlier, if the Fed's lower at a quarter or a half tomorrow, what does that mean for the first mortgage world, right? What does the 10-year treasury do? We've seen it go up sometimes. Employment, right? We talk about employment and the impacts of employment and the unemployment rates on the 10-year treasury, right? So there's a lot around different numbers that come out each week and how it's impacting the 10-year treasury, which is what typically the 30-year mortgage is based on, right? It's a big influencer, if you will. So, but in our world, we have that luxury of that not impacting us, right? And so we've been at the same rates for the last 30 days, say. And we've seen them. Since I've been at Spring EQ, which is coming up on a year now, I've seen us go up probably 3 times in a year, and it was very marginal. We have done nothing but trend downwards in the last 6 months. So it's been an amazing run. A lot of excitement, a lot of buzz around here.
And you could always refi your HELOC if they
You
go
can.
down. Yeah.
You can. Yeah, you can always refi your HELOC and continue to do a 3-year draw period each time. Our closing costs are super low here compared to what's out there,
Yeah.
which is nice. You know, you see closing costs on, say, a $200,000 loan on a refi cash out, you could be looking at 5, 6, 7 grand versus $1,800 on our world.
Yeah. So it's definitely a lot cheaper for
So
sure.
there's more benefit. We talk about, benefit the
And nothing out
consumer.
of pocket because it comes out of your proceeds.
Comes out of your proceeds. We don't even need bank statements.
Yeah. I mean,
Which is like, huh? You don't need
it's,
bank statements? But
yeah,
everybody
it's
needed
pretty
bank
cool.
statements. Yeah.
So a lot of good information in a 25-minute period. I told you it'd go fast, but
Yeah, very.
I think it's a huge win for everybody. And I know personally, I got to do a better job talking about it because I kind of put it to the side where I shouldn't. But I know there's a lot of people out there. I'm actually working on submitting one to you, if
Yeah.
not today, tomorrow, Angelo. And, just a good friend that's like, hey, I got some equity. I want to use it to my advantage. And the purpose of these is not to take out money and go on a bomb ass vacation and spend it all. The purpose of these is, I mean, you can do whatever
Sounds
you
good.
want. Yeah, then it's gone and then you're paying on it. But the purpose behind this, I think, and for everyone out there that's probably listening or who will watch this, is that if you're in a debt situation and you're kind of like at that brink and you're like, all right, I don't want it to get any worse, I think this is a huge product for you. I think if you have an older home that maybe you want to update it, you'd be surprised. Go watch Love It or List on HGTV. $50 to $75,000 can recreate your home. It's
Easily.
incredible.
And Matt, one thing I want
Yep.
to bring up, and I know we're running on time, so I didn't want to leave this out. Two
Yeah,
things.
hit it.
One, we have a lot of people that are paying their taxes, their income tax bills with the IRS off. Some people that I had somebody that had a $50,000 that they owed the IRS
So they
$50,000, and
must
they
be self-employed.
self-employed borrowers are paying their
Yeah.
taxes off like crazy right now, a lot of them. Secondly, and I don't want to get too deep into the weeds on this, but we didn't talk about appraisal evaluations, right, or property evaluations.
Yeah, talk about that real quick.
Real quick, I mean, 70% of our loans, 75% of our loans end up closing what we call an automated valuation model, right? An AVM. So you don't need to order an appraisal. You don't need to pay the $500 and $600 cost in most cases to get an appraisal, unless, the values on the AVM sometimes can come in a little light. We call it lower. So, but 75% of our loans do end up closing with an automated valuation model. So,
That's
which is
huge.
great. $45
So
in
that
most
saves
cases.
time and money.
It's time and money, and you don't have to. Yeah, you don't have. That's why we can get CT, a loan clear to
I was gonna ask you,
close.
so Angelo, for somebody that's got their stuff together, so they got their W-2s or tax returns clean, they're uploading stuff. Typically, from when it hits an underwriter's hands through final approval, what do you? And I know there's fast ones, but what do you think the average is? 2 weeks or less?
We under 14 days, but I
Okay,
would say the average is 10 days.
10 days.
Yeah,
So think
right
about
around
that.
10 days.
2 weeks, you're done. You get the money. Well, you got a rescission period afterwards, 4 days. But besides that, you're done. And sometimes the documents that they need, it might be like the insurance. Like sometimes that's a pain in the butt to get because you got to get your insurance agent, update that. But guys, this is an easy way for you to get yourself into a better position if you need to. If you need to upgrade your home because you're thinking about selling in the next 1 to 3 years, like now's a good time to do something like this because if everyone starts, rates start going down, values start going up, and then you're behind the eight ball because you're like, oh, we got to do our floors, we got to fix our bathrooms, we got to do whatever. Now would be a good time to do it. So just to recap, we talked about the benefits of doing a HELOC or HELOC. We talked about what they're used for. Angela talked about the assumable mortgage situation, which I think is fantastic.
Absolutely.
The rates are great. Speed is great. Everything's been great. And I'll be honest with you, the people that we have helped together, they've been very happy. And they know too, like, hey, listen, if rates get really low, they know they could take advantage of doing a refinance or something to pay it off. But again, if you sell your home, this is the cool part. This is something I want to add in there. So if you were to take out $100,000 in anticipation of selling your home, maybe in the next 12 to 18 months, you take out the money, you're probably making on 100,000, probably less than $1,000 a month, probably 700, 800 a month. for that payment to do all your remodels and stuff. As soon as you sell your house, that lien's paid off. You don't have to pay it all back. It comes out of your equity. So think about it. You're borrowing for a limited time. That's why I keep telling people, I was like, why don't we do a HELOC or HELOan to get your house up to par? And then, if you put it on the market and all that stuff and you sell it, it gets paid off.
Lending yourself money. What
You're
could be
lending
better?
yourself money out of your equity
That's it.
at a much cheaper payment than selling your stocks right now, which are probably killing it in the market. I had somebody, I was like, don't touch your stocks.
Yeah,
Why would
and
you do
most
that?
most terms, Matt, are 30-year. You do get 20 to 30 years. To your point, you're either gonna pay your mortgage off by that time, it's called due, or you're gonna sell the house, one of the two, or you're gonna refi, right? So one of those is gonna happen before that loan becomes due, right? And we all know that. We see it every day.
Yeah, I don't think
You're
anybody's sitting on a HELOC or HELOan for 30 years.
No, exactly. So like you're literally borrowing, you're basically giving yourself a loan for $200,000, 300,000. And we use these as examples, everyone out there that's listening, but we do go down to $25,000. So not everybody needs a $500,000 home equity line of credit. Some people need less. And so we have a wide variety of products. We have a wide variety of situations, scenarios for everybody out there. So there's a different flavor, if you will, for everybody. You do a great job with your partners with just communication with me, and I think together there's just a endless opportunity for us to help a lot of people out there achieve, like you said, whether it's credit card debt, whether it's upgrades to the home, whether it's a boat, whether it's a new property, whether it's a piece of land they want to buy
Paying
to
off your
build on,
taxes.
paying off taxes, all these things that we
Get
could talk
yourself
about.
right, people, with a HELOC or
Get
HELOan.
it right. Get it right
Get yourself
today.
right.
Let Matt and I lead you in that direction, and you will be a lot happier.
Well, I'm going to leave with this. So if you're out there and you own a home and you want to see what you could possibly qualify for and how much money you could get out of your home, do me a favor, shoot me a DM or a message. You could email me, matt@anchorhl.com. Give me a call on my cell phone, 239-666-5005. Feel free to reach out, and then all I really need is your value, how much you owe, and how much you're looking to take out, and your estimated Experian FICO score, because that's the FICO score that they use is your
Yes.
Experian.
Yes.
And I'll pass that on to Angelo, and we'll price it out for you. And if it seems like a deal, we'll get it through the door. So, Angelo, I appreciate you so much and jumping on
Likewise,
here.
buddy.
And
Likewise.
you know how we do it at Anchor. We want to make it stick and make it right. So if you need anything at all, feel free to reach out. And Angelo, thank you so much for your time, and we'll see you
Likewise,
guys
buddy.
later.
Everyone have a great one.
All right,
Thanks so
thanks.
much. Take care.